let's look at financial analysis. Prospective purchasers of stock, prospective employees, prospective lenders are going to look at the financial statements of a company from the past to try to make predictions about their future. And that way they can decide whether they want to buy the stock, whether they want to lend them money, or whether you want to go work for this company. So let's look at a couple different ways of doing financial analysis. First and foremost, we have to realize that just one number doesn't tell us anything. If I tell you this company made $85,500 in net income last year and ask you, is that good or is that bad? The answer is we don't have enough information. Suppose last year they made $10,000, then net income of $85,000 would be good this year. But suppose last year they made $200,000 and this year they only made $85,000. So a good answer when somebody throws you one number and says, is that good or is that bad, is it depends on the company and it depends on the industry. How did the rest of the industry do last year? One way we might get some context is to create common-sized financial statements. This is a common-sized income statement. We're going to have the results from 2015 and 2016 alongside each other. We're going to see that sales went from $725,000 to $900,000, while net income went from $50,000 to $85,000. Is that good or is that bad? Well, first, let's express everything as a percent of sales. So we'll simply take every number and divide it by sales. So 558,000 divided by 900,000 is 0.62. 0.62 is 62%. Over here, 435 divided by 725,000 is 0.6, which is 60%. And so now when we look at these things, we have a little bit more perspective. Our cost of goods sold went up from 60% to 62% of sales. And we can ask, why is that? And it may be that a competitor opened up, and so we had to lower our prices, so our cost of goods sold was higher as a percent of sales. Or maybe we had to source our goods someplace else and it cost us more money. So our gross profit went down. Before it was 40%, now it's down to 38%. But if you look, we controlled our selling and our general expenses so that our operating income went from 15% to 18%, so that our net income went from 7% to 9.5%. So by putting these things in a common size, we can quickly see that although cost of goods sold went up as a percent of sales, our net income went up as a percent of sales because we controlled our other costs during the year. Another thing we might do is ratio analysis. It's meaningless to compare the individual entries in a firm's financial statements with those of a firms that are not the same size. How could you compare Walmart with the local grocery store down the corner? They're just two different sizes, but we can do some ratio analysis and look at the percentages. And then we can make some conclusions about whether that local market's headed in the right direction or the wrong direction. All right, let's look at H.J. Boswell for the year ending December 31st, 2013. Here's their income statement. They made money. Here's their balance sheet. Here's their current assets. Here's their current liabilities. Here's their total assets, their total liabilities, and shareholders' equity. The first thing we notice is we only have 1 year's worth of stuff. So sometimes different textbooks will use average accounts receivable or average assets or average shareholders' equity for some of these ratios we're going to do. But since we only have 1 year, we don't have that luxury. The first thing we'll do is look at how liquid the firm is. Can they pay their bills? The first ratio, and this is the only one I ever ask students to memorize, is the current ratio. Current assets divided by current liabilities. Students often do total assets over total liabilities, things like that. The current ratio is current assets divided by current liabilities. So $643.5 million divided by $288 million gives us a current ratio of 2.23 to 1. That allegedly is going to tell us, do we have enough current assets to pay our current bills? Do we have enough stuff that is cash or will be cash within a year to pay our bills that are due within a year? The next ratio is the acid test ratio, sometimes called a quick ratio. Current assets are great, but it may take us a long time to turn that inventory into cash. We have to sell it and then collect on those bills. And so let's take that out and just have what we call our quick assets in the numerator of the current ratio. So that's the 643.5 minus the 378 divided by the current liabilities of 288 gives us 0.92. Next, we'll look at the average collection period. Two things worth mentioning here. Sometimes beginning students are looking at a retailer like a Kroger or Safeway or Office Depot, and they're focusing on the average collection periods. Well, those are cash businesses. People pay for their goods at the cash register. So those aren't as critical as they would be for a manufacturer who sends out a bill and waits 30, 60, or 90 days to get paid. The other thing to notice is that since we don't have any balance sheet other than this one, we can't use our average account receivable in this calculation. We just have to use our accounts receivable balance and divide it by our average daily credit sales. And nowhere on our income statement does it say these were cash sales or credit sales, so we pretend like they're all credit sales and take the whole kit and caboodle and divide it by 365 to get our average daily sales. So the average collection period is the accounts receivable balance divided by the average daily sales. And we get 21.9 days. Is that good or is that bad? Again, we need more context. What was it last year? What's the rest of the industry do? Next is account receivable turnover. We'll take our credit sales, and again, we can't tell credit from cash. We'll take our total sales and divide it by our accounts receivable. Again, other books might say average accounts receivable, but we only have this number here. We don't know the accounts receivable balance at the end of the year before. So you get 16.67. The way I think about this is if I have a drawer and I fill it up every time I send out an invoice and I empty it out every time that invoice gets paid, how many times do I fill up that drawer and empty it out? And I want to do it a lot. I want to send out lots of bills and get paid a lot of times over the course of the year. Next is inventory turnover. So what we'll do is we'll stick the cost of goods sold, 2025, in the numerator, and we'll divide it by inventory. And again, it might be average inventory, but we only have 1 year here. So in other words, how many times do we fill up our warehouse and empty it out? We want to turn it over a lot. We want a big number here. We get 5.36. Is that good or is that bad? It depends. What was it last year? What was it the year before? What is everyone else in our industry doing? The next two ratios are about how the company is financing its assets. The debt ratio is 54%. For the debt ratio, we take the total liabilities over the total assets. Total liabilities over total assets. For times interest earned, we're going to take net operating income, or EBIT, and divide it by interest expense. EBIT, earnings before interest and taxes, and divide it by interest expense. And again, different books are going to have slightly different formulas, but the notion here is how much debt should a company have? Just enough. It's the cheapest form of capital because interest is tax deductible. So we want to use as much as we can, but not too much. Is this just enough? Is this too much? Again, it depends. What was it last year? What was it year before? And what's the rest of the industry doing? So the next two ratios look at how management is using their assets to generate sales. Total asset turnover takes the total sales, $2,700,000,000, divides it by total assets, $1,971,000,000, and that's how we get the 1.37. Some textbooks will say be sure to subtract out long-term investments. So if we bought stocks and bonds of other companies, those investments don't really help us generate sales, so we should subtract those from the total assets when we do this calculation. Fixed asset turnover says take those same sales, $2,700,000,000, and divide it by net property, plant, and equipment to see how effectively management is using the fixed assets to generate sales. Are these good numbers? Are these bad numbers? We don't know. We need more information. The next five ratios are about adequate returns. Gross profit margin is simply gross profit divided by sales. For these guys, it's 25%. And should that be high or should that be low? And I always say it should fit your identity. Costco should have a low gross profit margin. Nordstrom can afford to have a high gross profit margin because they offer selection and service, so people are willing to pay higher prices. Operating profit margin simply says take your operating income, or since we're in finance now, EBIT, earnings before interest and taxes, and divide it by sales, 14.2%. Net profit margin, take your net profit, your net income, and divide it by sales. Return on invested capital, or sometimes this is called operating return on assets, takes your, again, your EBIT, your operating income, and divides it by the total assets. Return on equity takes your net income, this number down here, and divides it by the common equity. And please don't just divide by this common stock par value account. Remember, common shareholders' equity is everything down here. If there were preferred stock, we'd subtract out the preferred dividends before we did the calculation for the numerator. And the last two ratios are about where the managers are creating value for the shareholders. What's the PE ratio? That's an important ratio. The price per share divided by earnings per share. If we know that the price per share is 32 bucks, what's the earnings per share? Well, it's the net income of 204,750,000 divided by the 90 million shares that are outstanding. If there were preferred dividends, we would subtract those out because that money belongs to the preferred shareholders, not the common shareholders. And then the market to book takes the market price per share and divides it by the book value per share. Well, what's the book value per share? It's the total shareholders' equity of 911.25 million divided by the 90 million shares. So this says if your market value per share isn't higher than your book value per share, the marketplace is telling you you ought to just shut up your store, sell the stuff, and be done with it. So seldom is your market to book ratio going to be less than 1. So big picture, just one number from the financial statements of one company isn't enough information to make any kind of judgment. It's going to depend on the company. It's going to depend on the industry. Depending on the company, it's called trend analysis. So let's look at the trends within the company. And depending on the industry, translates to peer group analysis. Let's compare this company to other companies within its business. I hope that helps.